If you're a Canadian homeowner or you're trying to become one, here's my promise to you. The tactics I'm about to walk you through will help you not only save money, but protect your cash flow in today's market. Not theories, not clickbait, just real strategy that is working in today's market here in 2026. If you don't know me, my name is Tyler Wilson. I'm one of the top 50 mortgage brokers in all of Canada, and I've funded over $2 billion worth of mortgages. I spend every single day helping families firsthand get through the struggles that we're seeing in today's market. So if 2026 feels heavier than anything you remember, including 2008, you're not crazy. Let me explain why and what to do about it. You've probably heard this line already. 2026 is not going to be like 2008. And while technically that's true, the banks are stable, the system isn't collapsing, and there's not going to be a financial domino effect that is going to lead to some kind of crisis. However, what is different is what really matters. 2008 was a systems crisis. 2026 is going to be a household cash flow crisis. Back then, mortgage payments didn't jump overnight. Daily costs for average Canadians were stable, and most of the pain in 2008 remained inside of the financial sector. Canadians are sitting at the kitchen table, and that financial pressure is looking them right in the face in their own household. From thousands of conversations, comments, renewals, it's become clear that the stress is coming from three clear places at the same time. The first being mortgage renewals. Many Canadians are renewing their mortgage today from those low rates of 1 to 2.5% all the way up to 4%. It's a significant increase. Most Canadians are seeing an increase in their payment by 20 to 30% instantly. It's not a small amount. Secondly, people just can't deal with the higher inflation that we're seeing. In past downturns, you'd be able to cut back. Right now, groceries are up, insurance is up, fuel is up. So your mortgage payment is up and everything else is up in cost too. Third, and certainly not least, is our policy and tax issues here in Canada that continue to squeeze Canadians. Over the last 10 years, we've watched property taxes increase significantly. On top of that, we have had carbon pricing and environmental pricing that has been pushing up the cost of goods and services. And we've had no meaningful income tax relief with all of these changes. So this time, the system, it's not going to absorb the shock. You are. This is the part that actually matters the most. We can't control interest rates, we can't control inflation, but what we can control is structure. The first thing that we need to do is actually get our cash flow under control. The way that we can do that using our mortgage is extending our amortization. A lot of people get concerned about this, thinking that they've given up or they're going to be unable to get ahead of the interest in the future. They're not going to meet the timeline of, the 25 to 30 years that they originally set for their mortgage. It's important to note that this can just be a short-term strategy in order to improve your cash flow. There's nothing stopping us from accelerating those payments later or making lump sum payments to our mortgage in the future when we feel like we have a firm footing as far as our cash flow is concerned. The next thing that we need to do is audit where our money is going and the slow, quiet drains of money that is going out of our account every single month. In Chrystia Freeland's pro advice, cancel the Disney Plus, but not cancel the Disney Plus. What we need to take a look at are bank statements. What old subscriptions do we have? Where could we potentially save some money as far as cable, internet, phone, any of those kind of things where, we've maybe not paid close attention, our home insurance, our car insurance. There might be opportunities where we can fine tune those payments specifically and cut back on some of the monthly cash flow that's having to go out. Fixing all of these small things doesn't feel dramatic, but it does start to add up fast when we're looking at, $50 here, $50 here, $35 here. It could mean a couple extra $100 that you have every single month that buys you some of the freedom that you've been looking for. For people that already have mortgages, it's important that you start planning for your renewal now. We know that your payment's going to increase, and it's important that you start to make those adjustments. You can run the numbers early, figure out where things may be, and make those adjustments so that it's not such a shock when it comes to your lifestyle and your mortgage payments when you get to that renewal. There's also certain strategies and other opportunities that you should be considering at your time of renewal that may allow you to structure your mortgage so that it's more tax efficient in the future, or lower those payments so that, again, we're not facing as much of that payment shock as we might be if we just left it alone. 2026 isn't worse because the system's broken. It feels worse for households because we're carrying more risk than we ever have. And the ones that get ahead today are going to be the ones that aren't magically waiting for the interest rates to fall. They'll be the ones that adjust early, protect their cash flow, and start making decisions based on reality and not headlines. That's what we do here at Pilot every single day. If this helped you, please feel free to leave a like, subscribe, and tell me down in the comments what's really hitting your household the hardest these days. Is it the increased cost of living? Is it mortgage payments? Sound off in the comments and let me know.